Good evening, everyone. I'm Yamini Sood, and I warmly welcome each one of you to the DSP Investment Managers webinar. I have with me our head fixed income, Mr. Sandeep Yadav, today. And last week, obviously, was a week which everybody was closely watching. And I am sure that you would have attended a multiple of webinars, and that is why we did not want to be one of them. We decided to do it. We start with our outlook afresh on a Monday evening. So here we are, and I have with me Sandeep. I am going to encourage each one of you to ask as many questions. There is the chat box available, and if you raise your hand, I can also unmute you, so that because we want to keep this interactive, and we do not want this to be a monologue. All of you have been hearing Sandeep over, many of you would have met him one on one, many of you would have heard him before, and we've been pretty bullish, and we've been recommending to buy for the last few months. And this is a call where post such an important statement from the RBI that this is a pause, not a pivot. I thought, keeping with that context, I'll kind of take it up with Sandeep and ask him the first question for the evening. So while I'm going to keep it interactive, ask him a few questions, and I'll encourage again all of you to type your questions or ask me, and I can put forward those questions to Sandeep Yadav here. Sandeep, first question to you is this truly a pause and not a pivot, or do you think otherwise?
So yeah, I mean the first thing that went through my mind when the governor said it's a pause, not a pivot, and the first thing that came to my mind is there's a pivot, not a pause. And well, frankly speaking, it's not that I'm trying to say that RBI governor, I know more than the RBI governor, but it's more like RBI governor has historically tried to nurse the markets. Whenever they have come up with a surprise, they have tried to ensure, they have tried to ensure and tell the markets that this is really not something that they'll keep on doing for posterity. For instance, if you remember in 2021, when RBI came up with the first OMO sales, they did not say that this is going to carry on for 1 year. When they came up with the first liquidity tightening measure, that is VRRR, I think there was a sense right in the monetary policy. RBI said this is transitory. They did not try to signal that they are going to take away 10 lakh crores of liquidity. In April 2022, if you remember, there was a monetary policy in which RBI did not hike the rates, and they were quite comfortable on the inflation front, though within a span of 30 days, they hiked the rates. And we have seen these kind of communication coming from RBI. Just in the last policy, RBI hiked the rates, saying that for them, they said that for them, the core inflation matters more than headline inflation. Well, let's face it. I mean, we haven't seen a print of core inflation come since last monetary policy, but RBI has still hiked the rates. We have seen historically them saying that headline inflation is what matters, not the core inflation. So obviously, what I'm trying to say is that RBI has said that it's a pause, not a pivot. But just imagine if they would have said it's a pivot, not a pause. Today, your yields could clearly be somewhere around 675, 680, and that is certainly not something which RBI would want. So I'm not saying that RBI would have said it's a pivot or a pause, but where I see it, I think the risk for it being a pivot is more right now rather than it being just a pause.
So basically, you're saying not to go by RBI comments blindly.
Well, I mean, if you would have gone by RBI comments so far for the last 2 years, you would have ended up making losses, right? So I would say, yeah, probably RBI has got a longer and a bigger picture in mind rather than us investors.
Great. So if you talk to market participants and even RBI, there's this huge bearing on inflation always. When we believe that inflation is the single most important factor in deciding future rate trajectory. Though when I talk to you, Sandeep, and when we read our converse, we've noticed that you've always been skeptical of the same. So how much weightage would you really want to give to inflation as of now from here on? And if you could just share some data, some numbers to prove your point, to validate what you're saying, that would be really nice. And
sure, yeah. I mean, I think before I answer this question, whenever I say that inflation is probably not as important, I think somewhere I feel people might think that I don't know macroeconomics well. Let me put it this way. I was pretty good student of macroeconomics in my college. But I think 20 years of being in financial markets in India, looking at the debt markets, you just learn that, what works in developed economies and what works in theory really does not work in practice. And there are two reasons why inflation probably is not the primary concern, or not as important as maybe normal conversations make them out to be it television conversation, be it panelist conversation, or be it even reports that we read. And we've got empirical data now. We've got empirical data to prove what I'm saying. I think the first problem is that it's very, very difficult to predict inflation in India. So if anyone says inflation is going to be higher 6 months down the line, lower 6 months down the line, well, frankly speaking, the historical evidence shows that people have not been able to predict inflation. When 50% of your inflation is food, you just cannot. RBI has themselves, they have themselves accepted that they cannot predict inflation well, leave alone economists. And the second thing is there's empirical evidence showing that there's not much of a correlation between yields and inflation. So even if someone were to, predict inflation very well, it is unlikely that that prediction would have eventually ended up being with the moving yields the way they expected. This is a slide of a DSP converse that you were talking about. So probably the bottom right chart is what I'd like to show to everyone. Now, in this chart, the green line is the expected projection of inflation by economists as polled by RBI. So it comes in RBI's website every 2 months. And the black line is where inflation has been. It's been completely difficult to predict. And look at the orange area, that is the yield. It is not at all correlated with inflation. Now, why does it matter right now? And it clearly matters more right now is because we are at a higher end of the yields right now. When we are at the higher end of the yields, what it does is that if you're suddenly saying that don't buy the bonds because inflation will continue to remain higher, you're putting it too many things. You're stacking up too many things one over another. Firstly, at these levels, most of the economists' macroeconomic predictions are also probably a flat line, which I showed in my previous slide, a green line. They're not expecting discrete jumps. Now, what happens in macroeconomic data in India is that your data set suddenly goes very high or very low. And these are not predictable. These are driven by black swan events generally. And even I don't know what those black swan events could be. But where we are right now, when we are at a higher end of the yields, when we have already seen RBI hike for such a long time, probably those black swan events are going to be positive for yields rather than negative. It's very unlikely that suddenly, something will come up which will make RBI raise by 100 basis points. The probability of something coming up making RBI cut by 50 basis points is more. And that is why I don't go too much. I don't bank too much on the inflation projections right now. I think they are probably my projections or anyone's projection are as likely to go true as probably a roulette table. That is the way I like to put it. And that is where we are. We'd rather put our risks on risk reward. We'd rather position based on risk reward rather than just bank in everything on inflation.
Okay, thanks, Sandeep. So, what, according to you, will be the driver of yields from here on? While everybody talks about growth and inflation, and I also want to understand your estimates for growth. Do you concur with the 6.5% on RBI? Do you have any other thoughts? That's number one part of the question, and the other part is what will be the driver for yields according to you?
No, that's a good question, Yamini. I'll take your first question before because that is simpler to answer. When you said what is my expectation of growth, 6.5%. As I said, I'll just go back to what I said. It is innately impossible to guess macroeconomics 1 year down the line. I put a gun to my head, I would say that most probably we are going to be lower than 6.5 rather than higher. The reasons are multiple, but I think the biggest reason is that RBI has done a lot of rate hikes. The risk to that rate hikes and rate hikes impact in India with a lag. Everywhere they impact with a lag. In India, according to RBI, it takes around 9 months for the rate hikes to impact. And in such a time, when RBI has already done record hike in the last few months, I would probably think that those rate hikes might have a negative shocks going ahead. And if I were a betting man, I'll say that it will be lesser than 6.5%. What would impact? And I would just like to share probably this slide. According to me, these are the major things, that I've spoken about. Do not go with RBI's comments blindly. I've also spoken about macroeconomic forecast. Do not price in discreteness, and they're difficult to predict. These two points I've said. I've also mentioned about theoretical things not really mattering. So going ahead, what is it that I will look for? I think this is probably assuming that there are no black swan events and assuming, there are no shocks in the market. This is something which I would really look out for. And this is nothing but what US Fed does. Now, why is this important? If you look at RBI rate hikes, which are dark green lines and light green lines are the Fed rate hikes, RBI has literally been walking in step with Fed, just a step behind. When Fed was doing 75, we were doing 50. When Fed was doing 50, we were doing 25. Now, when Fed is doing 25, we are doing zero. Now, why does it matter? Despite the fact that Mr. Governor is saying that we run a very independent policy, there's significant data points to point that no, we are not. We did a rate hike on 4th of May 2022, one day before the Fed policy. This chart shows that we are tracking that. More importantly, the comments of Fed have been the comments of RBI have been echo of comments of Fed. When Fed said that we'll be higher for longer, that is exactly what RBI said. We'll be higher for longer. When Fed said that core inflation is what matters, RBI said core inflation is that matters. So today where we are sticking. I think a lot of part hinges on what US Fed does. I strongly believe that all it will take is one data point to come very negative, which is employment data in US, and I could pretty well expect the Indian yields to start crashing in following that. Why? It may not be immediate, but in the next MPC, you could probably hear Mr. Das being much more dovish than what he was, and probably it will be a pivot, not a pause at that time. And that is what I'll be looking out for. And sorry.
Go ahead. You want to talk about the risk to rupee because you've covered
Yeah.
the.
Yeah, so I would love, so, generally, as you said, for last couple of months, we've been advising investors to invest in duration. There are these three arguments that we generally get from investors that this is the reason why they don't want to invest. And it's important to look at these arguments. The first one is that there'll be a high supply. I think this argument started taking root in February, March, when there was no supply in G6. And suddenly, people were afraid what will happen if supply comes. Well, frankly speaking, the supply is not as large as it was last year. The incremental change is just 8%. India's nominal growth is growing at much faster clip than 8% of supply. More importantly, last year, why did yields not go to 8%? And I think that is the same reason why yields will not spike this year. And we were thinking that there's a decent chance for it to go to 8%. Why didn't it go? Well, states just stopped borrowing. So there was no supply coming from state bonds. Why did they not borrow? They were having a 3 lakh crore of cash when they went into the new financial year. What is the case today? Today, again, we are at 3 lakh crores of cash for the states. Again, in the first 2 weeks, states have just bought 8,000 crores against a calendar of 28,000 crores. So I don't think the supply is as huge. Probably the worst in the supply is priced in. Probably it's a deja vu of what happened last year. We could see the same thing happening. So I'm really not worried so much about the supply. There's a demand in India. 80% of India's demand is by institutions which have a nominal growth of 10-12%. And according to me, they'll take care of that supply. Second is higher.
Sorry, go ahead.
No, please ask.
No, my question was on supply. So which part of the curve do you think that the supply will be dominated on?
So we have already seen six in the latest H1 calendar, 6% extra supply in 30-year and 40-year bonds. We were expecting that, to be honest. And even right now, we think that probably it's best avoidable. Transitory, the spreads could narrow only rather than widen. But still, we think it's best avoidable 30 and 40 year. The supply is significant over there, while there's demand also. We think that 5-year and 10-year is a decent, does not have as much of supply, and probably there are good points in the curve to invest in. How about shorter tenor? We saw loads of supply of 1-year CPCDs, if you see in last financial year. That has stopped significantly right now as we speak, and no wonder, yields are significantly lower, probably around 30-40 basis point lower in a span of 2-3 weeks. So according to us, even the supply will be a little lesser over there. So across the curve, we are quite comfortable. Probably 30-40 year, we expect yields to spike up, the spreads to spike up, not yields, I'm sorry. And that I would still assume is something which most of the investors anyways would not be looking at.
Not mutual fund investors.
Yeah, not mutual fund investors. Probably they should look, since we are talking about that, probably they should look in next couple of months. So around May, June is, so we, just to let you know, we've got a long duration fund approval from SEBI. We are not launching it right now because we expect the spreads of 30 and 40 year bonds to widen. June is when we expect, probably the spreads will be wide enough and it will be lucrative to buy at that time. But right now we said don't buy, and probably we will be launching in May, June around that time when we feel that it's the right time when the spreads are wider. Sorry,
I
so
had
I
a
mentioned,
question. Sorry,
yeah.
go ahead.
Please.
I was just saying I had a question on global macros, but you pretty much kind of covered it. But anything apart from, we've seen, US home sales number kind of come down and you're seeing a slowdown there. So you covered that bit, but anything apart from US, anything in the UK, Eurozone that we should kind of also keep in mind, be cognizant of when we are taking a rate view from a global macro perspective?
So Yamini, it becomes a little bit difficult because in our latest converse, last month we wrote that only that the risk to black swans have increased. Now I don't know what those black swans could be. I have no idea, but I think probably the shocks could be something which have been difficult to predict, rather than which are looking quite visible right now, and it'll be difficult to say. But most of these shocks, even though I don't know what the shocks could be, but I think those shocks could lead to a sharp downtick of yields rather than higher. But since you asked, I think Sudhir has asked a question over here. I think quite related to what you just said. He's asking that more financial crises are looming in US and Fed is increasing interest rates, indicative of that they are more concerned with inflation. Isn't it a shoot yourself in the foot? And what will be the impact on India if one more rate hike is
Yeah.
there? So a very good question. Fed is raising interest rates, but Sudhir, just to let you know, what happened was between the policies, if we see before the Fed's policy and just before the SVB and the Credit Suisse occurred, the peak Fed rate was expected to be 575, 580. The Fed lowered it down by 60 basis point in a span of 2-3 weeks. So I think somewhere Fed is going has tamed down the interest rate hikes that they were planning to do, and they are cognizant of it. Shooting the foot, probably yes, but what I will just repeat what Fed Powell said in last Q&A after the FOMC. He was asked a question that what did in fact, I'll not even say that, I'll rather say what he said in the last policy. He said the cost of bringing the inflation down is very high, but the cost of not bringing the inflation high is even higher. So basically, if inflation keeps on rising up, it will be probably shooting in the head rather than the foot, and that is where Fed is worried about. Sorry if I just missed your second part of the question. Just a sec, please. And what will be the impact? Now, this is a very good thing that you asked me. So what I'll do is I will actually take you to a slide. What happens if there's another rate hike? And I will just take you to a slide which is part of a DSP converse. And in fact, I was speaking to a few people today only on that. What happens if there's another rate hike? Now, there's a worry, right, that if there's another rate hike, then yields could really spike up and all. In my opinion, not at all. This is a deja vu of what people were saying 1.5 years back, right? That yield curve is so steep, overnight rate is at 330, 5 years at 5.5%, 200 base point. Even if rate hikes happen, yields will not rise. And we all know what happened. Yields rose by 200 base point. I think it's a converse deja vu right now when people are saying that rates will, if hike happens, what happens? Will the yields rise up? And just look at this slide. In two instances in the past, there have been when RBI has paused from the rate hikes, the spread between the repo and the 5-year and 10-year yields has crashed down significantly. That is what's going to happen right now. If there's another rate hike, I don't think yields are going to move much. What will happen is your repo could go to 675, but your bond yields could remain here. Why? Because we have seen in the past, just before the rate cut, at times the yields of 5-year and 10-year have gone below the repo. So I think the spread is quite rich right now. Repo over 5-year, 10-year, especially seeing that we are the peak rates, and I'm not too worried about another rate hike impacting the yields.
Okay. Sandeep, one question. We have been saying, and even today we're saying about that, it's a good buying opportunity. So what can really go wrong to our buying view?
So the first is that comes to my mind is dollar rupee. Clearly dollar rupee. We have seen that there's a lot of comfort even from RBI when it comes to dollar rupee, but it remains a worry. And we have seen our CAD has stabilized, but we have also seen that our balance of payment has not really increased sufficiently, while the FX reserves have increased. But we are not seeing equity flows, we are not seeing debt flows, the capital flows are not coming. So that remains a worry for me. That will be the biggest worry. The second worry remains a supply. We are talking about so while I don't expect supply to be big, but then we are in a year of election, and you don't know when the government may decide that they want to give more fiscal impetus going into elections, and they might just come up with a lakh or 2 lakh crore of extra borrowing. Though I think it will take 8 9 months before they announce the same thing. But that remains a worry, right? In an election year, anything can happen. But I think most of those risks are contained where we are right now. You could see yields moving up by 10 basis point, to be very honest. But I'll say that take it in a stride, because we have just seen a 150 base point yield spike up. So a 10 15 base point is something which people should not be worried about.
Okay, so this is my favorite question, and I think this is my pet question: is which part of the yield curve? While though you explained that where the spreads are likely to rise and all of that, so it kind of answered, but still, just to articulate, which part of yield curve looks attractive to buy right now?
So I
While we've
think I
seen in the last few sessions, the curve has also steepened slightly.
yes.
Like your short end has come off and long end has gone. Kind of remained come down, but not so much. So, which part of the yield curve looks better?
No, that's a good question, and probably I'll answer it a little conversely. I'll start saying which parts of the yield curve I don't like, and then probably zone in to the one that I like. I don't like 30-year and 40-year. Yes, even if yields fall down, the duration of 30-year and 40-year is not so much so, that it takes care of the risk. So the curve is quite flat right now. 10-year cross for 40-year is very flat. If yields fall down, what will happen is that the curve will steepen. If the curve will steepen, your 40-year will move much lesser than 10-year will. If your 10-year moves much more, then even though it will have a lower duration, you'll end up gaining more money in 10-year rather than being 40-year, because it will move lesser. So we've done a lot of correlation and statistical analysis, and it just seems like a plain trade, right? Go for 10-year, don't go for 40-year right now, where the yield curve is right now. The higher risk in 40-year is still not going to give you more money, because 40-year is going to move lesser than 10-year because the yield curve is steep. So let's instead of saying 40-year, let me say 15-year plus. I'm painting the whole part of 15-year plus in the same brush. That it's not a good point to invest in. Less than 5-year. Well, frankly speaking, you could invest in less than 5-year. One could argue that the curve is 15-20 base point worse off you're getting. But why I don't like it is if the yields do come down, you're just not making any capital gains. Let's say you're in the 3 or 4-year roll down, 3 years down the line when yields are much lower. You have just got the level that you have invested in. You don't get any capital gains. So I don't like really short-term 3-year and all that segment, because somewhere, the duration is so less that you don't benefit from yield coming down. Instead of that, what I prefer is a 1-year segment. 1-year segment still gives you much higher yield than a 3-year. And the fact is, if you do if yields come down, 1-year will also not give you capital gain, but 3-year will also give you nothing to talk about kind of capital gain. Then there are only 2 points of work left, which is 5-year and 10-year. And frankly speaking, it just keeps on switching every couple of months. The spread, when it widens today, when spread is a little bit wider, I would tend to go with a 10-year. Why am I going with the 10-year? For 2 reasons, largely. One is, well, the spread has widened. We have seen that when rate cuts start happening, this spread initially goes to zero, or it really negates quite a lot. Even if the spread remains where it is, if the yield curve actually falls down 100, 150 base, or not 100, let me even say 50, 60 base point, not too much, you will have significantly more capital gains in 10-year than 5-year. So currently where we are, I prefer 10-year to 5-year, because higher duration, spread is again widened. Probably it may even widen further. But the fact is, if the yields fall down, you end up making a lot more money, even though 10-year may fall lesser than 5-year, but the duration increase of 10-year is better. So currently where we are, 10-year it is.
Okay. And what about your view on liquidity from going forward and impact on money market rates? Would like to talk about that as well.
Absolutely. So liquidity is, in fact, when you ask one of the risks, I should have mentioned liquidity also. Liquidity is a risk, but RBI did mention, right? RBI spoke in length about liquidity after Monetary Policy Committee. So according to me, liquidity is tightening quite a lot. It will continue to tighten, but not at the same pace that a lot of people expected. There are a little bit of technical reasons which I would probably not want to go into. But through FY24, we'll see liquidity tightening significantly. I don't think VRR, the transitory method that RBI does to infuse liquidity, will be sufficient. RBI will have to come up with a CRR cut, basically reversing the CRR hike that they did a year back. Not now, but probably a few months down the line. They will also have to come up with OMO purchases. They'll have to buy the bonds, which will again bring longer term yields lower. So where we are right now, liquidity is tight. I think it's going to become tighter, but it's not going to go into a panic zone, because before it goes into panic zone, and we have seen Mr. Das doing that, he's nursed the market so well. And before it goes into panic zone, I think RBI will come in and take strong actions to push in permanent liquidity whenever it is needed.
Thank you. Thank you, Sandeep.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.